Hello and welcome to episode 148 of Simply Tax. It's Friday, September 2nd, 2022, and we thought what better way to kick off a discussion about a big change under current law for research and experimentation for tax years beginning after December 31st, 2021, than to do some research and experimentation of our own by finding a way to give your usual host, Damien Martin, a break with an automated voice. What do you think? While we may see a legislative change later in the year, a change enacted under the Tax Cuts and Jobs Act is already in effect in 2022 for calendar year taxpayers. And that's why we're excited to share with you on the podcast today a discussion with Mike Boenzi, the Research and Development Tax Credit Leader in the Federal Tax Credits and Incentives Group at FORVIS. Take it away, Damien. Well, maybe we just kind of jump in a little bit here. That sounds good to you.
Yeah, let's do it.
I always like to start our conversations, and I always say that it's like the thing we start our conversations with, like, who are you? Like, why are we even talking? Because I guess I always look at it as like, I like to know the person I'm listening to before I decide if I want to listen to what they have to say, to be fair. So just who are you? What's your background and what do you do?
First off, thanks for the opportunity to spend a little bit of time with you here this morning. So my name's Mike Boenzi. I'm a managing director in our Chicago office, and I lead our research and development tax credit practice. This is an area that I've spent over 20 years assisting clients implementing and documenting the credit and supporting federal and state examinations of the credit. Over that 20-year period, I've worked with a variety of clients, from startups to middle markets to Fortune 500 companies across a wide range of industries. In addition to the R&D credit, while I am a subject matter expert in that area, I've also spent some time in a broader federal credits and incentives practice. So also assist clients with other opportunities in that particular realm.
What are a few, just out of curiosity here?
The employee retention credit is certainly an area that continues to be a hot area where a lot of clients are doubling back now and taking renewed looks at whether or not there's opportunities to claim that credit. In addition to that, the Section 48 investment tax credit for any companies that are looking to implement energy efficient property, the Section 45 production tax credit for any companies that are generating their own electricity, as well as EV credits and disaster retention credits as well for any companies that have locations in federally declared disaster areas that were affected by, storms, straight line winds, hurricanes, tornadoes, et cetera.
There's been so many more of those. I just feel like every year there's just like the numbers kind of keep going up so that's huge. So
yeah, absolutely.
All right. Well, before we get to some of the tax stuff, let's. I always like to throw a couple just get to know you questions. So, you're a Chicago guy, right? So,
born and raised.
I don't know. Summer's part of the reason how I ended up living in Chicago. I'll have to tell you that story someday. But there's lots to do in Chicago in the summer. So, what's a favorite of yours?
I think one of the great things that I love to do, especially with my family and my kids, is just go catch a Cubs game at Wrigley. In my mind, there's no better place to be on a Friday afternoon with the sun shining, 80-degree weather, than catching a Cubs game at the old ballpark.
Oh, yeah. That's a favorite of mine, too, actually. In the trip that ended up leading to me moving here, there was a Cub game on it was like a July afternoon where it was just fantastic weather. So, all right. Do you have a favorite movie or movies? I'll give you, because if you ask me, I don't think I can name one, to be fair. So you can have that liberty as well.
Yeah, I mean, that's a good question. There are so many great movies that I've seen over my lifetime. If I had to name one, it would probably be most likely The Godfather.
Good stuff.
That is one of the classics of all time. I think, that trilogy ended up winning something like 9 Oscars. Marlon Brando at the time, people thought his career was washed up in 1971 when they filmed the original Godfather. He went on to win an Oscar for playing Don Corleone, and then, Al Pacino played the same role. And actually, that was the first movie of all time where somebody won an Oscar for playing the same role in 2 different movies.
That's not something you see. That's unusual, right?
It is.
Pretty cool. This is a testament to the movie, perhaps, in the series there.
Absolutely. What a great trilogy that was.
Yeah, absolutely. There's a while there where I feel like every time we come on or something, I'm like, I got to watch it.
It is a time investment.
It's time investment.
I will tell you. Each one of those movies, I think, is pretty close to 3 hours. So
Right.
When you get some spare time on the weekends, check it out.
There you go. Yeah, there you go. Let's switch it back over to the
tax world.
The tax world here.
Right, sounds good.
I was going to try and maybe draw like a parallel to The Godfather or something. I'm sure there's one there, but we'll just pretend like it was a great one that I made,
Right.
Maybe we just start with this section 174.
Okay.
And maybe just explaining what that is and why that's sort of been a significant item here in 2022 for everybody.
Yeah, I mean, this is one of those items that has, I think, largely flown under the radar screen up until this point. And so this was one of the pay-fors coming out of TCJA in exchange for lower corporate rates. It was one of the more significant provisions because what it did was it took away the ability for taxpayers to currently deduct research and experimentation costs. And, obviously 4 years has gone by awfully quick.
Telling me.
We've all had our heads down over that last 4 years, hoping that Congress was going to take some sort of legislative action to repeal this rule prior to its effective date, or at least kick the can down the road a few years, right? And so now, all of our clients and taxpayers in general are just more or less facing the reality that this rule is now effective and looking at how are we going to deal with the compliance aspects of this rule. It's significant because U.S.-based R&D is now amortized over a 5-year period and non-U.S.-based R&D is amortized over a 15-year period, which in actuality, when you look at the statute, it's actually 6 and 16 years because it uses a mid-year convention. So essentially, in the year in which the costs are incurred, a taxpayer gets the benefit of deducting 10% of those costs in year 1, 10% of those costs in year 6, and then the rest of it in between years 2 and 5, essentially. And it's interesting because, for example, if you look at the R&D incentives in the U.S. and you compare it to, other countries like China as an example, in China, if a company invests $100 in research and development, they get a $200 deduction for that $100 investment. Whereas in the U.S., with these rules now in place, if a company makes a $100 investment, they get a $10 deduction.
In year one, yeah.
In year one.
With the backdrop of a more favorable incentive in other countries and mounting pressure from many, there has been much discussion in Washington to roll back the changes to research and experimentation deductions created under the TCJA. Earlier this year, we saw 2 possible legislative vehicles where language that would change the required capitalization and amortization of Section 174 costs was involved in the conversations related to the bills. Those being the CHIPS and Science Act of 2022 and the bill informally known as the Inflation Reduction Act of 2022. But 2 additional remain.
The other possibility might be a tax extender bill, because at the end of 2021, there were about 40 or so tax, deductions and credits that expired that retroactively get reinstated every couple years with legislative action by Congress. And so that is something else that Congress is likely to take up here before the window closes with the midterm elections from a legislative calendar perspective to potentially get a bill passed as far as that's concerned. If the prior options fail, then after the midterm elections, in all likelihood, we'll probably see a larger omnibus spending bill coming out of Congress once the dust settles on the midterm elections, just in terms of funding various priorities on a go-forward basis.
But it sounds like there's some bipartisan support there, like you're saying,
Yeah.
and so I think everybody seems to generally be okay with the idea. It's just you got to figure out how you're going to make it happen.
Yeah, there is tremendous bipartisan support. And in fact, over the last couple of years, there have been numerous bills introduced in both houses of Congress to repeal this provision prior to its effective date. Unfortunately, because of the gridlock on Capitol Hill, again, finding the right vehicle in order for this type of provision to pass is really the challenge at this point. And given the inflationary environment that we're in right now, any sort of government spending is likely going to be paired with some additional pay-fors. And that's really the challenge, right? It's not figuring out who's going to get the benefits of these various tax provisions. It's finding ways to pay for them. But with respect to this mandatory capitalization provisions, the bucket of potential costs that are considered to be research and experimentation are much larger under 174 than what they are under 41. And that is because while credit eligible activities include direct research, direct support, and direct supervision, Section 174 from an activity perspective could include other things that are not included for 41 purposes, like foreign research or research after commercial production or patent perfecting and filing or reverse engineering or research that's deemed funded for research credit purposes or internal use software that's not highly innovative. And so because the spectrum of activities is much more broad for 174 than 41, it requires clients and taxpayers to really do a much broader analysis of costs that maybe haven't been considered in the past for, as it relates to the research credit. Similarly, on the cost side, for research credit purposes, we typically include wages and supplies and contract research, right, as the three main buckets. In some cases, when we're talking about software development, we can include things like sandbox type environment costs as it relates to cloud computing and rental of cloud experimental sandbox space. In the 174 world, in addition to those three buckets of costs, things like non-taxable employee benefits, an allocable portion of SG&A, depreciation, rent, utilities, patent fees, foreign research costs, and all software development costs are now de facto 174 costs.
That's huge.
It is huge because that's an issue that transcends industry. I mean, no matter what industry we're talking about, right? There's always the pursuit of making your processes more efficient, implementing software that's going to enable greater capabilities from an organizational perspective, right? No matter what industry we're talking about. And so whether it's an ERP implementation, whether it's mobile applications, e-commerce, et cetera, there are a host of implications, just broadly speaking, across many industries for software development, because up until this year, taxpayers were able to rely on Revenue Procedure 2000-50 to deduct software development costs for tax purposes. And now with these new mandatory capitalization rules in effect, they now define software development costs as Section 174 costs. And so regardless of whether the software is used internally or sold, leased, and licensed to an outside third party, they are going to those costs are going to get caught up in this capitalization provision.
Well, we had John Simply Tax Talks, right? And this was back in, I think it was early February. We'll include a link there to it. But you were talking about that distinction, which was even just, I guess I was aware of a distinction, but not really even just how much broader that 174 bucket is compared to the 41 bucket. Do you think that that's really started to set in, or are you having some conversations around it? Or do you think people are taking let's see what happens if with maybe one of those vehicles, and let's just fingers crossed that we don't have to actually deal with this? What's kind of been the reaction you've been seeing so far?
I would say by and large, it's been mixed. There certainly is a broad cross-section of clients and companies that I've talked to recently that have largely been taking a wait-and-see type of attitude up until now, hoping, again, that Congress was going to take some legislative action to provide a technical fix for this issue. However, what I'm starting to see is that as we are getting into estimated payments, the implications of this rule change are starting to take effect, obviously, and have to be factored in for purposes of federal tax payments, state tax payments. There certainly are implications from an international perspective to the extent that companies are claiming the foreign tax credit, FDII, GILTI. There is an allocation of R&E expenses that goes into the calculation of those provisions. And so there certainly are implications from that perspective. And then certainly from an effective tax rate standpoint, from a taxable income standpoint, not only in the current year, but forecasting going forward, as well as interesting decisions that have to be made around buy versus build, as an example, as it relates to software. Is it more beneficial to, rather than develop software internally or perhaps hire an outside third party to develop that software, do we just buy a proven solution from an outside third party, right? And so we get the benefit of bonus depreciation and those sorts of things. In addition to that, I think Section 174 was added to the IRS's list of compliance campaigns a couple years back. And I think as the service begins to become more organized around the issue, 174 and 41, the research credit, which obviously over the years has enjoyed a healthy amount of attention from the IRS. I think taxpayers are going to need to have their documentation buttoned up as far as their analysis of their 174 costs, right? And so, my recommendation really for clients that have not spent the time looking at this is, there's really no better time than the present to begin to plan and model and evaluate the impact of this provision on taxable income, cash taxes, estimated payments, and related international provisions. And one of the other things that I've also seen or heard in my discussions with clients is that many clients just simply don't have a process in place yet to identify the spectrum of 174 costs that they have. This type of analysis is going to take some time to implement, not to mention if there are steps involved from a process standpoint in order to capture these costs, it's also going to take time to implement those process steps as well. And so, my recommendation to clients and businesses in general is really take the time, start looking at the impact of this provision if you haven't already, because from a holistic standpoint, there are a lot of potential implications of this from a tax perspective.
So I'd be curious on the documentation side, what does that look like? Like how do you go about making sure you have the right, you've got your buckets identified and you've got it clearly delineated kind of what the treatment is?
Yeah, that's a good question. There's no defined roadmap, I would say, for every single business that just works, generally speaking, for every business, right? I mean, I've received questions around this as to, let's say, for example, we start with the cost that we claim for the research credit, right? And we gross up our contract research costs. Is that an acceptable methodology to estimate our 174 costs? And my answer to that is that may only be one piece of the puzzle. What my recommendations to clients are from a documentation standpoint is really to start with the departments or cost centers that first and foremost are generating your core R&D expenses. So that would be to the extent that companies have an engineering department, right, or an R&D department. Certainly those costs, I think, are slightly easier to identify just because it is a core department, a core cost center in which, largely the salaries of folks in that department are considered to be research and development costs. What the challenge, I think, for companies and clients is identifying those indirect costs, those tangential costs, right? Things like non-taxable employee benefits, overhead-related items. So let's say a company has a lab, right? Some of the depreciation of that equipment in that lab, as well as if it's a separate lab and they're paying rent for that lab, as an example, right? Some of that rent could get pulled in as a 174 cost. The first step, my recommendation for a lot of companies is to look at it more on a departmental or a cost center basis. Identify those departments or cost centers where you have employees that are performing 174 type activity, right? And 174 activity is defined as any activity which seeks to eliminate any uncertainty around the development or improvement of a product. It could be your core R&D and engineering department. You could have a process engineering department, which is captured somewhere else on the trial balance. You could have some costs that are sitting in cost of goods sold, as an example, the trial materials that are ultimately sold to a customer. So it's really taking a broad view of the organization, starting with those departments or cost centers, developing a reasonable approach in terms of allocating some of the indirect costs that are being captured in those departments or cost centers towards the 174 bucket. Quite frankly, it takes time to work through this analysis, right? And like I said, there's no well-defined roadmap for each and every company that broadly applies across all industries. It really is dependent on the facts and circumstances of every company, where they're capturing these costs. Part of the issue is also that up until this year, some of the costs that may have been included for purposes of research credit under 41 may have been captured for tax purposes under other sections like 162, ordinary and necessary business expenses. They may not have been treated as 174 costs up until now. Whereas now, any costs that go into the research credit are required to be treated as 174 costs and capitalized and amortized. So there's some interesting decisions that have to be made in terms of what costs do we claim towards the research credit. For our non-core engineering R&D costs, does it really make sense to capture those costs and claim it towards the R&D credit, or is it more beneficial to deduct those costs instead? At the end of the day, clients that are required to capitalize and amortize costs for purposes of 174 and claim the R&D credit are going to establish a deferred tax asset in all likelihood that is going to benefit them in future tax years. What it then becomes is an issue of, the discounted cash flows associated with those future deductions, right? And what's more beneficial today versus a stream of deductions in future years.
Really what it sounds like is that the math and the modeling involved in kind of, does this make sense and does this work and should I be doing it, really changes as a result of this.
It does. It does. And it differs depending on whether we're talking about a C Corp or we're talking about a flow through like an S Corporation or a partnership, because certainly there are implications at the shareholder and partner level that have to also be considered, not just at the entity level as well. So there are some complicating factors that go into this analysis. It's not only developing a process to identify these costs and come up with a reasonable allocation of indirect costs, but it's also, once you get to that point, analyzing the downstream impact for a S Corp or a partnership. It's also developing that go-forward process or putting that go-forward process in place so that in future years, it becomes easier to identify these costs.
And oftentimes, again, I think especially with the R&D credit, the 41 credit, you just start to, you hear about the benefits of it and then maybe not think about some of those other downstream impacts, to your point. So let's switch over and look at that. And maybe just to back it up a little bit, the R&D credit, I mean, how long has it been around and who does it benefit and why,
Yeah, so this credit has been around for over 40 years now, came into existence in 1981 with the Economic Recovery Tax Act under the Reagan administration. At the time, there was some concern about intellectual property flowing offshore, and so Congress decided to institute this type of credit to try to keep intellectual property here in the U.S., reward companies for investing in innovation and providing an incentive to do that effectively. Now, this is an activity-based credit, right? So it has nothing to do with the technological level of innovation that your product, your processes represent. Really, to the extent that any company, regardless of industry, is undertaking, product development or improvement, process development or improvement, developing, new methods, new techniques, new formulations, developing software to use internally or sold to an outside third party, or looking to make their processes more efficient, develop custom machinery and equipment to institute in a production process, developing intellectual property, patents, things of that nature. Although not a requirement, certainly it would give rise to an opportunity. This is an incentive that broadly applies to many different industries. And quite frankly, I can't think of an industry that it wouldn't necessarily apply to, just given the broad-ranging nature of activities that could give rise to this opportunity.
You've been out there getting on that soapbox, trying to help to demonstrate that it goes a lot further than just maybe what you would generally think of the in the lab with the lab coat R&D. But are there things like that maybe are misconceptions about the R&D credit that you feel like either stand in the way or sometimes you need to look out for when considering the credit?
Yeah, I mean, there's a lot of myths out there about the credit. Some companies are under the impression that if I'm not developing something that's new to the industry, I can't qualify for the credit. And simply, that's not true. I mean, as long as a company is developing something, whether it's a product or a process that's new to that company, not necessarily new to the industry, it can in fact qualify for this credit. The other thing that's important to also mention here is that I do anticipate there to be a push in the coming years to make the R&D credit more generous, just in terms of the ability for companies to utilize the credit. One of the opportunities that's out there for qualified small businesses and startup companies is to utilize the credit to offset payroll taxes, because oftentimes these businesses in their early stages are not generating taxable income, right?
Right.
So companies may believe that there's not a benefit to looking at the credit when they're in their early stages and not generating taxable income and paying cash taxes. But the reality is that's not true, because there's an opportunity to use up to $250,000 of a credit to offset payroll taxes, effectively monetizing the credit, right?
Yeah.
That's one of the other misconceptions that I've heard out there is, there's really no benefit to looking at the credit if I'm a startup company or a small business because I'm not paying cash taxes at this point.
Hopefully, maybe even with the ERC and some of those conversations that started to dispel that myth a little bit of you getting to see the benefit of, wait a minute, I am still paying taxes. I'm paying payroll taxes and getting,
Right.
Getting a credit
Right.
that can offset. What's the definition of a small business for this purpose, I guess?
It's a business that has less than $5 million of gross receipts in the current year and does not have any gross receipts outside of the 5-year period, including the current year. I see this opportunity as an opportunity for a wide variety of startup and small businesses that are under that $5 million threshold in the current year to monetize this credit. Could be a valuable opportunity.
Maybe even those that maybe have aspirations and really will someday from their plans be much larger than that in terms of their gross receipts, right? I mean, if you haven't really started doing much and you're in that prototype phase, whatever, it's very likely you don't have more than 5 million in gross receipts, right?
That's right.
Yeah.
That's right. Absolutely. And because of the wide-ranging nature of the opportunity that exists here with a variety of different activities that are being undertaken, even if companies do an initial feasibility and scoping analysis of the credit with very little investment in time and effort, this is one of those opportunities, the value of which can be uncovered very quickly for an organization. And the nice thing is that once a process is established to claim this credit, it becomes an annual recurring annuity to businesses every single year to the extent that they establish a process to capture these costs and claim the credit. And so most recently, as of 2018, based on some data that was published by the IRS Statistics of Income Division, the credit amounted to about a $25 billion incentive for the private sector. So it is one of those corporate tax benefits that truly is one of the largest that's out there right now. And I only expect that to grow as time continues. I mean, as companies continue to come out of the pandemic and pivot their business models, new products, new processes, new ways of doing business, right? It's only going to lead to more and more opportunities just across the board to claim this type of activity-based incentive and benefit. There's broad bipartisan support for the credit, generally speaking, in Congress. And I wouldn't be surprised if in the next handful of years we see, legislative action taken to increase the value of the credit itself. As I stated earlier on in our conversation, the U.S. R&D credit on a global scale is it falls somewhere between 20 and 25th most valuable R&D incentive of any major industrialized country across the globe. And so we certainly have fallen behind from the perspective of our ability to compete with countries like China and some countries in the EU, just in terms of ability to attract R&D investment. There's a lot of companies, just generally speaking, globally, that have in the EU instituted patent box provisions and things of that nature that are significantly more beneficial than the U.S. R&D credit. And certainly, I think there's a recognition there on Capitol Hill that things need to change, the credit needs to be enhanced, and so I would look for some action to be taken on that.
You mentioned earlier documentation, kind of getting your documentation house in order. I know last year there was a chief counsel memo around some of the documentation, even the requirements now for the R&D credit. Can you talk a little bit about those and what you need to be doing as part of that process of claiming the credit?
Absolutely. So last year in October, the chief counsel memo was issued, field service advice, basically applicable to amended return claims for refunds resulting from the research credit. And so for any companies or clients that are considering going back to prior tax years to amend tax returns to claim refunds resulting from the R&D credit, it's especially important that they pay attention to the guidance that's contained in this particular CCM. And really what the CCM does is it puts new rules in place that require taxpayers to include certain minimum information in a disclosure that's filed with their amended returns. And this disclosure statement really has to contain 5 main things. First of which, it needs to identify the projects or the business components that form the basis of the amended return claim for credit resulting from, the research credit. And so what are those projects that form the basis, right? That's the first thing the IRS is going to look for in this disclosure. The second item is a list of research activities that actually took place on the projects themselves. So what did the taxpayer do and how did they do it? That's essentially what the IRS is looking for, a narrative, some sort of description, right? Mm-hmm. The third item is a list of individuals or contractors that performed qualified research activity on those projects, right? So a list of employees, their job titles, any contractors that perform qualified research. They're looking for a table, a list, a narrative, some sort of indication of what individuals or what contractors those were. The fourth item that the IRS is looking for is really a list or a table of what the specific goals of each one of the projects were that formed the basis for the credit claim. What I liken this to is essentially a description of what the permitted purpose of the project was, right? So we undertook Project A in an effort to develop this new or improved functionality, performance, create a higher quality product, result in a significant cost reduction, improve reliability, things of that nature. That's essentially what the IRS is looking for a description of. And then lastly, the service is looking for total research costs by project, so wages, supplies, and contract research. My personal thoughts on the CCM are, while it's not overly burdensome to perform this type of analysis, it's a formula that has to be followed in order for the IRS to accept your claim for refund on any prior amended returns. And I do think from the standpoint of the way we as a firm execute on our clients' R&D studies, this is information that we would gather during the normal course of what a typical R&D study would be. And so for that reason, I don't view these requirements to necessarily be overly burdensome. In my mind, it's almost repackaging information that would be gathered during the normal course of an analysis and putting it into the form that the IRS is essentially looking for. While it's not de facto evidence that a taxpayer has adequate documentation to support their claim, this type of disclosure does give an indication to the IRS that the taxpayer has gone through a thoughtful analysis of their activities and credit, and it is likely that adequate documentation does exist to support the credit.
Yes, to your point, it's not really new. It's just kind of repackaging. But I guess if you weren't really doing the work and now it's hard to show your work, so to speak, right? That's basically what they're asking you to do, show your work a bit on these amended claims.
Yeah, in my discussion with IRS leadership that issued the guidance contained in this chief counsel memo, I mean, certainly the IRS recognizes that over the last several years, the volume of amended return claims for refund have significantly increased, right? And so because of that, the IRS was looking for a tool or a mechanism to at least determine initially through almost not necessarily a desk audit, but just a desk review almost when the claim comes in, is it more than likely that a taxpayer has the necessary documentation in order to support their claim? And so one of three things can happen when that amended return claim for refund is filed. One is, in a perfect world, right, that claim would be processed, the refund would be issued, life is good. The other option is if taxpayers file that disclosure statement with their amended return and there is missing information in that disclosure statement, we're in the midst of a transition period with respect to this guidance right now. So before, I think it's January 11th of 2023, if a taxpayer files an amended return with this disclosure and there's any missing information in that disclosure, the IRS will send correspondence to the taxpayer letting them know what's missing, and then the taxpayer has 45 days to perfect their claim for credit.
That's not a long time.
No, it's not a long time, exactly, to provide that missing information.
Yeah.
And so that's a potential trap for a lot of companies in that if prior to filing that amended return, they hadn't gone through a thoughtful analysis of the credit and gathered the necessary information, you could find yourself in a situation where you're scrambling to gather that information in order to be able to perfect your claim within that 45-day window. Now, that all changes on January 12th of 2023, where the transition period expires, and then any amended return claims that are filed after that date, to the extent there's any missing information, taxpayers will not have the opportunity to perfect their claims at that point. So the IRS could, at that point, just deny the claim when it's filed due to multiple reasons or multiple pieces of information that might be missing at that point. So that's scenario two. Scenario three is there's no missing information in the disclosure. The claim comes in, the service assigns it to their field service staff for further examination, right? And so there's three possibilities that could come about from the filing of that amended return. But at the end of the day, again, I go back to what I said earlier. If clients have gone through a thoughtful analysis, if they've worked with their service provider to perform this sort of detailed analysis, they're going to be well positioned to be able to provide the information that's necessary as part of this disclosure.
Yeah. Otherwise, it'd be particularly onerous if you didn't do it, perhaps. And maybe that's what they're, to your point, getting at with this approach is it's sort of like a way to vet that out of the gate and kind of show that maybe the work wasn't, in fact, there. One of the interesting things, probably some of the things I enjoy about tax is you can look at the Internal Revenue Code, you can look at the guidance. There are aspects where it spells it all out, but then there's areas of interpretation on a lot of these things. So there's the gray areas, so to speak, that end up getting worked out through showing up in tax courts or wherever. There's always a number of developments that are happening on that front. And I feel like lately there's just been quite a few headlines in the space of maybe some of the developments. So could you talk about some of those and maybe why they're impactful and important?
Well, there's definitely a couple trends at a minimum that I'm seeing in the IRS audit environment, and a lot of it stems from the court case decisions that have come down in the last couple years. In addition to that, as I mentioned before, as the IRS continues to reorganize around the credit, as well as hire additional engineers nationally to work on examinations of the R&D credit, combined with these recent court cases, it signals a couple of things. One is that the IRS is more willing to challenge taxpayers on a broader range of issues as relates to the R&D credit. And then secondly, it's very likely that we're going to see the volume of R&D credit exams increase over the next couple of years. And so one of the more significant cases that was decided last year was the Little Sandy Coal case. And this was a pretty pivotal case because it shined a spotlight on an issue that I think a lot of taxpayers don't necessarily focus on when they're analyzing their activities and costs for purposes of the credit. So Little Sandy Coal at a high level involved a shipbuilding company where the IRS had decided in this case that the taxpayer did not provide adequate information to document that the activities that were performed were 80% or more a process of experimentation. So when we're talking about the qualifying criteria for the credit, there's 4 criteria, one of which is the activities have to be part and parcel of a process of experimentation. In looking at that particular requirement, the way the court applied the rule is to say, okay, when we think about the process of experimentation, think of a ratio, the numerator of which is all of the costs associated with those employees that are performing direct research, meaning hands-on type of research. It's your core R&D, your core engineers, folks that are participating in maybe the testing process and that sort of thing, right? All of that goes into the numerator of this fraction. The denominator is all of the costs associated with that particular project, including direct supervision and direct support, okay? One of the interesting things in this case is that as the court was analyzing the projects in question that formed the basis of Little Sandy Coal's credit claim, they went through an analysis of this ratio and found that the majority of the projects that actually formed the basis of the credit claim, when you kind of compute this ratio, didn't rise to that 80% or more threshold. The implication that has for clients today that are claiming the credit is that for many clients, they don't have any sort of project tracking system in place, time tracking system in place. So, there's a lot of tools out there to be able to gather employee time estimates and that sort of thing for purposes of the credit. And so it really places a spotlight and an emphasis on, as companies are gathering estimates of time for individuals that are in a direct research, direct support, direct supervision capacity, it's important to make sure that that time is classified appropriately, whether it is direct research, direct support, direct supervision. A machinist that's machining a part for an experimental model, right? Some may interpret that as direct support. Some may interpret that as direct research. I would interpret that as direct research because in the absence of that activity, the process of experimentation could not continue, right?
Yeah.
There's a whole host of other examples from that perspective that we can throw out there. And so for every project that forms the basis of a company's credit claim, that type of analysis needs to take place. And I think up until the issuance of this court decision, there was very little emphasis placed on that particular requirement, specifically in the way that the court applied that rule in the Little Sandy Coal case. And so now, it's really incumbent upon our clients and any businesses just in general to ensure that the proper information is being gathered in order to perform that type of analysis to validate that each of the projects that form the basis of a credit claim meet that particular provision. And what's interesting is I've started to see in the exam environment more and more information documentation requests from the service come down asking for taxpayers' analysis of this particular provision relative to all of the projects that form the basis of the credit claim. And I've actually seen the IRS become much more aggressive in disallowing credit claims in instances where taxpayers cannot provide that level of information. And so it's really important, again, that there's some thought put around this particular issue and that it's addressed in the course of gathering information around the research credit. In addition to that, one of the other trends that I'm also noticing is that this issue of identifying business components or projects that form the basis of a credit claim. A lot of times what I see is there's taxpayers out there that perform an activity-based analysis, right? So when they gather estimates of time for employees or look at what sort of supply costs qualify for the credit, what sort of contract research costs may qualify for the credit, that time, those costs are really allocated to activities and not necessarily to business components or projects that form the basis of the credit claim. And more recently, one of the trends that I've started to see is that to the extent taxpayers are unable to define what their business components are, the projects that form the basis of the credit claim, as well as what the costs that are associated with those business components or projects, the IRS has started to become increasingly aggressive at disallowing the costs associated with certain aspects of taxpayers' credit claims in instances where they can't provide that information. You know, what's interesting is when you go back to the legislative history behind the credit, you know, Congress on multiple occasions has said that taxpayers claiming this credit is not contingent upon unreasonable record-keeping requirements, you know, burdens placed on companies claiming this credit. But at the end of the day, credits are a matter of legislative grace. And so the burden of proof is really on taxpayers at the end of the day to support their entitlement to the credit. This is a very dynamic environment. It's not a static environment. You know, we're constantly looking at our processes, looking at it through the lens of what's happening in the IRS audit environment, looking at ways to better position our clients to substantiate their benefits in the event of a potential examination, and working with a service provider that's in tune to what's going on in the IRS audit environment can be a very valuable asset, because just as businesses constantly are looking to improve the way they do things, we are as well. And we're also looking to also adapt to what we're seeing in the IRS audit environment too. And so these are just a couple of things to keep in mind for companies that are maybe in the next cycle of looking at the R&D credit. Ask yourself, are we gathering the proper information to be able to address some of these issues that we're seeing in the audit environment right now? And if we're not, how does our process need to change?
As with anything that's been around for a period of time, you sort of think, oh, I've got it down, I've got it figured out. But no, I mean, things are changing and at a pretty quick clip and rate. So you really got to evolve the process. So is there anything that we haven't talked about so far that maybe you would add, or maybe just something you would leave somebody that's considering or has been working with the credit to be thinking about in this environment right now?
Yeah, there's just a lot of things happening right now in the credit environment. The mandatory 174 capitalization rules, things that we're seeing in the IRS audit environment, the fact that over the last several years, we've seen a number of taxpayer favorable court cases come down, which have expanded the opportunities for companies to pull in costs that maybe they've historically shied away from across a wide variety of industries. And so my parting thoughts are, for any companies that are currently claiming the credit, have you taken a renewed look at the credit to see, are there ways to further maximize the credit based on what we're seeing right now in the industry? Or from an IRS audit, if you've had a negative IRS audit experience recently, there are ways to better position you going forward into the future to be able to take advantage of this particular opportunity while managing some of that risk. And then at the same time, for any clients or businesses that have not previously considered claiming the credit, now is a great time to take a look at it. Like I said, even in a feasibility or scoping type of initial exploratory assessment, our team, we're working with a number of clients across a number of industries that have not previously claimed this credit, but because of the various tax provisions and implications of what came out of TCJA and the wind down of bonus depreciation over the coming years, a lot of companies across a variety of industries forecasting more taxable income in the years to come. Now's a great time to take a renewed look at this credit, see if you could take advantage of it, put a process in place not only to identify your 174 cost, but in the process claim a very valuable credit. And so my team and I are happy to assist any businesses out there, and certainly feel free to connect with me on LinkedIn, give me a call, visit our R&D Tax Credit Services webpage on our external website. We are certainly ready and willing to help.
I was looking forward to this conversation in part because I feel like every time I sit down with you, or even just an opportunity to be on a call with you, there's a nugget I pick up. There's something again, perspective, just watching the environment and how this is all rolling out and continuing to evolve that I pick up from you. And you are just always willing and just so knowledgeable in the area. So yeah, I always say, I don't know if we have like really speed dial anymore, but if I had speed dial, you'd be on my speed dial for all things R&D.
Thank you. I appreciate that.
Please check out the links we've included in the show notes to this episode, available at forvis.com/simplytax. Damien needs followers, so please connect with him on social media. You'll find him out on Twitter, where he tweets about tax at Damien Martin, CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax channel, and on LinkedIn. Finally, we want more people to find out about Simply Tax. Please leave us a rating and review on Apple Podcasts. I'm not really Damien Martin, but thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. FORVIS is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.